Everyone blames inflation in Argentina, but the real choke point is a $60 billion web of IMF and foreign debt. It's the invisible hand on prices, jobs, and politics. Miss a target and the peso wobbles. Hit it and austerity bites. Here's the plan. We'll unpack how this debt actually works, why the austerity fight is so bitter, and what it means for your grocery bill, bus fare, and paycheck. The stakes are deadlines, scarce dollars, and a confidence spiral. There's one clause in the IMF deal that changes everything. We'll get to that first, the mechanics of Argentina's money machine. Why debt dictates everything now. Okay, so basically, Argentina's economy runs on dollars it doesn't fully control. That's why debt dictates everything. When you owe the IMF and private creditors in dollars, every policy choice filters through one question. Do we have enough hard currency to pay, import, and calm markets? If the answer is shaky, inflation rises on expectations before any new pesos are printed. Here's what most people miss. The $60 billion isn't one clean loan, it's layers. IMF tranches that arrive if you hit conditions, rollovers of old bonds, central bank swaps, a mix of official and private obligations stacked into maturity walls, big lumps due on tight dates. In other words, the calendar, not just the amount, squeezes the economy. Now, the dollar problem. Argentina earns dollars by exporting soy, beef, lithium, and soon more energy. But it spends dollars on fuel, imported inputs, pharma, tech, and yes, debt service. Think of it like a factory running on credit. Revenue arrives in bursts, bills come due on schedule. If a drought hits exports or a delay blocks an IMF disbursement, the cash draw is light. Then everything slows. Meanwhile, the central bank's reserves look large on paper but thin in reality. Gross reserves include deposits and swaps. Net reserves, what's actually usable, can be close to zero or negative when obligations are counted. That's why multiple exchange rates exist. There's an official rate for trade, a financial rate for bonds, and various taxed or regulated channels. The gap between them acts like a silent tax on growth. It pushes exporters to delay sales and importers to front-load orders, which makes the dollar shortage worse. Conditionality 100:1. The IMF's logic is textbook. Aim for a primary fiscal surplus, tighten money, cut generalized subsidies, and rebuild reserves. The idea is to cool demand, reduce the need to print pesos, and restore credibility. Locally, the costs are immediate. When energy or transport subsidies are cut, prices jump before incomes adjust. Unions push for indexation to protect wages. Provinces resist cuts to transfers. Congress edits or stalls reforms. The politics gets loud. Here's the weird part. The very tools meant to stabilize can accelerate inflation for a while. Indexation clauses in wages and rents lock in past price rises. Money financing, even if reduced, keeps feeding expectations when trust is low. Import controls, meant to save dollars, create scarcity that lifts prices. So you get the feeling of braking and accelerating at the same time. Micro story. When the parallel rate jumps, pharmacies ration imports because suppliers won't quote. Factories idle a shift because a tiny imported part is stuck. Supermarkets pull price tags to reprint tomorrow. The missing supply is confidence. When everyone thinks the peso will buy less next week, they try to buy now or not sell at all. Everything clicked when I realized the exchange rate gap is also a story about time. Exporters withhold, importers rush, households sprint to hard assets. The state tries to stretch dollars across obligations and essentials. With thin net reserves, each shock, bad harvest, oil spike, political fight, kicks the system into a tighter corner. So what does the $60 billion mean in practice? It means every quarter the government must show two things: fiscal numbers that point to a primary surplus path and reserve numbers that meet targets miss, and IMF disbursements stall, and the central bank burns more scarce dollars or tightens controls. Tighten too hard, and the economy slows further, weakening tax revenue and confidence. Therefore, the debt architecture sets the tempo for everything else. The credibility bind sits at the center. Markets want proof, sustained primary surplus, fewer monetary tricks, and a smaller FX gap. Voters want relief, stable prices, jobs, and working services. The bridge is consistency, policy that holds long enough to shift expectations. But consistency costs political capital. We know the engine now, a dollar-dependent economy with thin net reserves, multiple exchange rates, and conditionality that front-loads pain. Next, the austerity fight that turns those mechanics into street protests, congressional battles, and the daily math of bus fares and electric bills. Austerity fight, cuts, pushback, and the inflation trap. Now the cuts. To unlock IMF money and steady the currency, the government moves fast. Spend less, print less, and prove it. On paper, the goal is simple. Flip the budget toward a primary surplus so the state isn't borrowing just to pay its bills. In practice, it means trimming the biggest, most sensitive lines first. What actually gets cut? Energy subsidies top the list. For years, households and firms paid well below cost for electricity and gas. When those subsidies shrink, utility bills jump. Transport support is next. Bus and train fares rise to reflect costs. Provincial transfers get squeezed, forcing local governments to delay projects or pay teachers later public works slow or stop. Because pausing a road is easier politically than cutting pensions. And inside the state, wages are frozen or limited, while cost of living clauses try to pull them higher. That tension shows up every payday. Here's what most people miss. Austerity is front-loaded pain with back-loaded gain. When you slash subsidies, prices move first. The fiscal savings arrive over months as the lower subsidy bill accumulates. So real incomes drop now. The math is brutal. Your utility bill rises before your wage or tax relief adjusts. That's the inflation trap. You cut to stabilize, but the cut itself pushes measured prices up, and people feel poorer. The political economy gets loud. Unions push for automatic indexation to protect purchasing power. If wage bargaining locks in past inflation, it keeps price momentum alive. Even as the state tries to cool demand, provinces resist losing transfers, arguing that hospitals and schools can't absorb shocks without chaos. Congress becomes an arena where reforms get rewritten, delayed, or split into smaller pieces. Meanwhile, the street sets a veto of its own. Transport strikes, marches, and sectoral stoppages increase the cost of holding the line. The credibility bind tightens. Markets want a sustained, not one-off, primary surplus. They watch if payrolls, procurement, and energy outlays actually fall in real terms. Voters want immediate relief, lower inflation, stable jobs, working services. One policy misstep that widens the exchange rate gap and trust vanishes. The state then must clamp imports harder or sell more reserves, reviving the same scarcity that drives prices. Everything clicked when we mapped the fiscal anchor against the social floor. The anchor is the cap on spending and money creation needed to stabilize. The social floor is the minimum support needed to keep reform legitimate. If hikes in electricity and bus fares push households below that floor, reform loses backing. That's where targeting matters. Instead of blanket subsidies that burn dollars for everyone, the state tries means-tested support and time-limited cash transfers. But targeting takes data, administration, and time, three scarce things mid-crisis. Sequencing is the quiet lever. If you hike tariffs and fares all at once, the pass-through hits core inflation hard. If you stagger increases and pair them with credible signals, like a fixed adjustment calendar, transparent cost formulas, and modest temporary transfers, the shock can be spread. The counterintuitive part is that clear rules can soften the blow because firms stop guessing future costs, and households can plan uncertainty, not just price level does the most damage. Let's make it concrete. Utility tariffs rise to reflect import costs and grid losses. Fares increase to cover fuel, maintenance, and wages. Those hikes push up businesses' cost base. Bakeries pay more for ovens, buses cost more to run, cold chains for food grow pricier. That cost push leaks into core inflation. If the central bank holds the line, tight money, fewer pesos, demand cools and the pass-through fades. If not, expectations reset higher and the loop continues. Here's the weird part. Even successful cuts can look like failure in the short run. You meet fiscal targets, but inflation prints higher because you normalized prices. People don't see the counterfactual, the debt you didn't issue, the pesos you didn't print, the reserves you didn't burn. They see higher bills. So how do you keep the coalition intact? 3 moves help. 1. Publish a simple, hard timetable for price normalization and stick to it, monthly, not ad hoc. 2. Target support to low-income users with automatic enrollment and digital payments, so help arrives before the bill. 3. Protect a few visible public services, transport frequency, medicine supply, so people feel something still works. Credibility is cumulative. Each kept promise buys room for the next step. But there's a trapdoor. If cuts outpace the economy's ability to earn dollars, if factories can't import inputs, if logistics stall, activity contracts faster than the budget, improves tax receipts fall. Then the surplus you aimed for slips away, and pressure returns to print or borrow. That's why austerity can't live apart from the dollar game. You need the inflow to match the squeeze. Austerity, then, isn't just numbers on a spreadsheet. It's a moving balance between a fiscal anchor and a social floor, between market patience and street patience. Manage both, and you build credibility that lowers inflation over time. Miss either, and the exchange rate gap reopens. Which brings us to the second lever: the dollars, how they come in, how they go out, and the maze that turns them into prices. The dollar game, exports, imports, and the exchange rate maze. Dollars decide whether factories run and whether the peso survives the next shock. When there are enough, shelves fill, energy flows, and the currency calms. When there aren't, the system grinds. Credit dries up, prices jump, and policy gets cornered. Start with exports. The soy complex is the cash cow. Beans, meal, and oil bring in chunks of foreign currency after harvests. But it's boom-bust. A bumper crop floods the central bank with dollars. A drought starves it. Energy is the new hope. Shale gas and tight oil can flip the fuel bill from deficit to surplus, but pipelines, storage, and pricing need time mining, especially lithium, adds a future stream. Yet projects require imports and stable rules before they ship a single dollar home. Meanwhile, many exporters use pre-financing. They borrow dollars abroad against future sales to bridge the gap. If the FX outlook looks shaky, they withhold shipments waiting for a better rate, which delays dollars when they're needed most. Now, the import side. Argentina imports the economy's bloodstream: inputs, capital goods, and pharma. A small component for a machine tool, a chemical for food processing, a spare part for a bus, miss anyone and output stalls. Import licenses become rationing tools. When authorities slow approvals to save dollars, firms run down inventories, then cut shifts. The ripple is real. A delayed shipment in one sector raises costs in another, and consumers pay at the checkout. Here's where the exchange rate architecture warps behavior. There's the official rate used for trade. There are parallel financial rates used to swap bonds and access dollars indirectly. There are tax channels for card spending and savings. The gaps between these rates breed arbitrage. Exporters see pesos per dollar higher in the parallel market, and wait, Importers see cheaper official dollars and rush. The state fights the rush by tightening licenses and taxes, which widens the gap again. It's a loop. So what about devaluation risk? Policymakers face a choice: one-off reset or gradual crawl. A sharp move can clear pent-up imbalances fast, narrow the FX gap, and boost export supply. But it also lifts local prices quickly as import costs reprice, feeding inflation and hurting balance sheets with dollar debts. Gradualism spreads the pain, but it can fall behind expectations. If people think the crawl will lag inflation, they reset prices anyway, and the gap survives. Contracts, bank assets, and utility tariffs add landmines. Move too fast, and you trigger losses that ricochet through lenders and service providers. Reserve rebuild is the quiet scoreboard. You add dollars through the current account, more exports than imports, plus financial inflows, and sometimes debt disbursements. Capital controls try to hold dollars in by limiting outflows. If you liberalize too early, residents dollarize savings, firms prepay foreign debts, and reserves drain. If you hold too tight for too long, investment stalls and the parallel market swells. The art is sequencing. Ease when net reserves are clearly rising and expectations are anchored, not before. Here's the clause that changes everything: net reserve targets in the IMF program. They're not about gross reserves on a brochure. They're about usable dollars after accounting for swaps and obligations. Miss the quarterly target, and the next IMF disbursement stalls. Stall, and the central bank either tightens import flows further or watches the FX gap widen, hit the target, and the program releases dollars that relax the squeeze. That clause sets the rhythm of policy: tariff hikes before harvest inflows, debt placements before seasonal demand, import pacing to avoid breaching limits. Remember this detail. It's the metronome behind each announcement. Let's ground this with a micro story. A mid-size manufacturer needs a specialized bearing. At the official rate, it's affordable. At the parallel rate, it doubles. The firm applies for an import license. Approval lags because the reserve target is tight this month. Production slows, cash flows shrink, and the company delays tax payments. Now the budget weakens, which forces faster cuts elsewhere, which reignites protests. Meanwhile, the bearing finally arrives after a mini devaluation, and the new price lifts the product's sticker. One missing dollar cascades across jobs, prices, and politics. So what's the game plan? Align incentives. Narrow the FX gap with a credible path that exporters believe. Clear export tax rules, predictable devaluation pace, and quick VAT refunds in pesos that hold value. Prioritize imports with the highest multiplier, inputs and capital goods, while digitizing licenses to cut discretion. Publish a reserve path tied to export seasons so firms can plan financing and communicate the rule. When net reserves rise, controls ease. When they fall, controls tighten. People can handle discipline, they can't handle surprise. Even if dollars start flowing, the debt still rolls. Bonds mature, IMF reviews return, and politics tests resolve. That's why the dollar game sets the table but doesn't finish the meal. The next question is brutal: refinance on better terms, or reform deeper so the need to refinance shrinks. Paths out: stabilization, restructuring, or stagnation. Now the fork in the road. There are three paths: credible stabilization, messy muddle-through, or restructuring round 2. Each has a cost profile, a timing profile, and a politics profile. Stabilization first. The simple version is anchor the budget, unify the exchange rate, and give money a rule. That means a tough primary surplus that doesn't rely on one-offs, a clear path to converge multiple FX windows into one market rate, and a monetary framework that everyone understands. No backdoors. Think of a rule like the central bank won't create pesos beyond a set limit tied to reserve growth pair that with a social shield targeted cash transfers and energy lifelines to keep the reform legitimate. The why is trust. If firms believe the FX gap will narrow and stay narrow, they price less defensively, invest a little, and the inflation drift starts to slow. But credibility needs signals you can't fake. Publish transparent fiscal data on a fixed schedule. Set hard budget constraints on state companies and provinces. Commit to a medium-term plan with milestones, monthly tariff steps, quarterly reserve ranges, semi-annual tax simplification. Every Met waypoint lowers risk premia and stretches maturities, which buys time. Growth has to do some work. Dollars don't appear from speeches. So push the near-term engines, faster energy evacuation to export gas and oil, logistics fixes that cut trucking and port delays, simpler tax regimes that reward formal investment, and practical capital market reforms so firms can finance in pesos that hold value. The test the market watches is boring but decisive. Sustained primary surplus, steady reserve accumulation, a shrinking FX gap, and declining inflation expectations in surveys and indexed contracts. Second path, muddle through. Keep controls, drip small devaluations, bargain each IMF review, and patch holes with ad hoc taxes and delays. It can avoid collapse, but it also locks in high inflation, low investment, and periodic mini-crises. Politics frays because pain drips rather than clears. Third path, restructuring again. If targets become unachievable, reserves miss by miles, growth collapses, politics blocks consolidation, the state may need to reprofile debt or renegotiate with the IMF that can reset the calendar and reduce interest, but only if paired with a credible stabilization pivot. Without that, it's just kicking maturities forward while expectations worsen. Risks stalk all three: political fatigue, external shocks, commodity swings. The counterintuitive part is that speed plus clarity can be kinder than drift. If people see the path, they can plan. Which brings us back to what that $60 billion really means for daily life over the next year. The takeaway and what's next. The core truth: Argentina isn't just battling inflation, it's battling a dollar shortage wired into IMF reserve targets and a politics that decides who absorbs the hit. That reserve clause is the metronome for reforms, prices, and whether shelves fill or contracts stall. Want the practical playbook, case studies of stabilization models that actually worked and which parts Argentina can copy now? Watch our next breakdown and subscribe to The Economy channel for weekly deep dives. Tell us what you want unpacked next: energy exports, FX unification, or wage indexation. We'll go there next.